I'm going to help you understand a little bit about Section 4 of the UK Corporate Governance Code, but before I do that, I need to explain something that applies to all the sections of the code. The code is not set out as a rigid set of rules. Instead, it offers flexibility through the application of principles and through a comply or explain provision. And what this means is the code is encouraging companies to comply with it, but they don't have to, and they're allowed to explain their non-compliance. Now remember that, because we're going to refer to it when we have a quick look at an aspect of Domino's Pizza. So let's have a look at Section 4 of the code. And there are three key ideas going on in this audit risk and internal control section. First one is this, the external audit. Now this is where a firm of auditors who are separate from the audit committee check the externally presented annual report and accounts. So where it says financial and narrative statements, that's the financial and narrative statements of the externally published annual report and accounts that the external auditors are checking. And they're making sure that those numbers show a true and fair view within a reasonable error of tolerance. And they're also making sure that those annual reports and accounts present a fair, balanced and understandable assessment of the company's position. Now, it does have a little bit of prospective information in an annual report and accounts, but between you and me, accounts show a position and a historic sense of awareness. So I wouldn't consider prospects as a major issue there. The second idea is the notion of internal audit. Now, the audit committee oversee the internal audit. And what do the internal auditors or the internal audit department check? Well, they check the systems and processes inside or internal to the organisation. And an organisation will have controls that will hopefully make sure those systems and processes work. That's why we're interested in the internal control framework. That's linked to the internal audit. Finally, there's a notion of risk. Risk is the idea that something could go wrong, and we want to either make sure it doesn't go wrong, or if it does go wrong, we've got a plan in place to look after the organisation. So there are three key ideas. Let's have a look at the first one, this notion of external audit. And you know where we're going to go. We're going to have a look at Domino's Pizza Group PLC. So it's a public listed company, and companies actually saying, look, we need to have an audit of this organisation. It's not just the code that's telling us we've got to do this. So there's always an independent auditor's report. Remember, the independent auditor is an external organisation. It's not the audit committee. And here we can see that PricewaterhouseCoopers have signed off this annual report and accounts to say it's shown a true and fair view of the organisation's position at the particular time the accounts were signed off. And this is important for our little review. They're signing them off on the 4th of March 2020. Now, there's a lot of work that goes in to auditing a big company's accounts like this, and you can find out actually how much the auditors were paid. This is in millions. They were paid £700,000. Now, you might not understand if £700,000 is a lot of money or not very much money. The best way I can explain it to you is this. Imagine about 60 professionals working for a month, long hours, to check all the information in these accounts. And that's probably about the amount of work that PwC have put into making sure that these accounts show a true and fair view, and that we've got a fair, balanced and understandable position shown to us. Now, personally, I think UK audit is fairly good, and I've got a lot of respect for auditors, so I wouldn't listen to everyone when they say to you, oh, you can't trust an audit. Now, let's have a look at what the auditors are actually checking. Remember, we're looking at the financial and the narrative statements. So when they talk about checking the financial statements, maybe think about the income statements, and we find out about the revenue and the profit. Remember, we haven't done very well this year. But remember, our UK and Irish businesses are doing well. It's the sale of the Nordic businesses and the problematic European businesses that's caused this very small profit to be shown. So they're the financial statements that the auditors have checked. But remember, the auditors also look at the narrative statements. Now here's a narrative statement. Anything where there's loads of words is a narrative. And the interim chairman is saying this: we are pleased to report continued solid growth in the UK and Ireland. Now, let's think about that. Is that fair? Yes. Is it understandable? Yes. Is it balanced? Well, this is why auditors have a difficult job. It's true that they've had a good year in the UK and Ireland, but a massive part of the story of Domino's is the sale of these problematic audit businesses. But we're not being told about that specifically in that headline. So hopefully you can start to see that when the auditors start to look at the narrative reporting, it's a far more challenging job than the reporting, which is why you can't rely as much on what an audit report says about the narrative reporting as opposed to the financial report. Let's go back to our code. And let's now have a think about the Audit Committee. Now, the Audit Committee are not the external auditors. And the Audit Committee are going to appoint the external auditors. They're either going to appoint internal auditors or manage an internal audit function, and they're going to govern the risk. Now, the Audit Committee is comprised of independent non-executive directors. And to maintain a very independent Audit Committee, the code says the chair of the board should not be a member. Let's remember that, and let's have a look at the Audit Committee composition within Domino's. So here we're shown about who's on the committee. Helen Keyes, she's a non-executive independent director, that's fine. Kevin Higgins, he's an independent non-executive director, that's fine. But look who chairs the committee. It's Ian Bull, our interim chairman. Now, that is not in compliance with the code. But remember, so long as a company explains what's going on, then that's fine. And so here we have the chairman's explanation as to why he's the chair of the Audit Committee. At present, he writes, I am performing multiple roles as interim chair, senior independent director, and chair of the Audit Committee. This is the explanation. Whilst this is far from perfect from a strict governance perspective, it is necessary for an interim period whilst we recruit a new chair. So when the shareholders see that, they can decide if they think that explanation is reasonable or unreasonable. And then there's a political process that then unfolds if they don't think that they're happy with the governance. But you're not breaking the law, you're simply not complying with the code in that situation. Let's go back to our UK code. Talked about external audit. I've talked about the Audit Committee. Let's have a look at internal audit now. Now, this is probably the least spectacular aspect of this section, but it is really quite important. So here we go. Within our Domino's Pizza, the Audit Committee will tell us a little bit about their internal audit work and what they've done to check the systems, processes and controls within the organisation. Now, it's not the most exciting stuff, but if you're on an Audit Committee, it is very challenging. The problem is you haven't got enough resource available for you to be able to give a perfect opinion as to what's happening in the organisation. And another reason why internal audit is so challenging is because some of the things you look at are really, really difficult. So here we're hearing about how the Audit Committee has tried to get an awareness of how robust their IT systems are and how strong their cyber security is. And that's a really technical issue, and it will require an awful lot of technical awareness to be able to give a good opinion. So, internal audit, very challenging, not the most exciting thing to read about. Let me just make one comment. How do the Audit Committee actually find out about these systems in processes? Because remember, it's comprised of non-executive directors who themselves don't get involved in the business. And the answer is, you either have an internal audit department who work as employees of the company, or you employ some internal auditors from a consultancy firm. And here we'll see that KPMG were the internal auditors. So they'll have been paid for doing the internal audit work for the Audit Committee. Now the challenge there is twofold. One, those internal auditors are different to your external auditors, and you'll learn more about that in your audit classes in level 6. But the other point is they cost a lot of money. So it's a very skilled job to work out how much work to get your internal auditors to do for you as an audit committee member to make sure that you've drawn an appropriate conclusion. And finally, let's have a look at risk. Remember, risk is something that could go wrong, and making a plan if it goes wrong, or trying to do something to make sure that it doesn't go wrong. So again, the companies will show us about their risks in the annual report and accounts. Here, the boards continue to identify, evaluate and monitor risks. Now remember, these accounts were signed off on the 4th of March. Remember, we went into lockdown with the virus on the 23rd of March, and here they are telling us about the risk of the virus. So that's a nice example of something that could go wrong and making plans around mitigating the problems. But here we're going to have the board telling us about what they think are their 12 major risks. So we're going to have a little activity here. If you were a non-executive director of Domino's Pizza, what do you think some of the key risks would be? Remember, a risk is something that could go wrong, and if it went wrong, it would have a major impact on the business. And there's 12 of them disclosed in the annual report and accounts. Now try and have a think about what they might be, but to help you get a couple of them, remember these things. They got rid of some of their troublesome Nordic businesses and are back to operating in the UK and Ireland, where they've got a fairly good coverage of franchises across the country. And a lot of those franchises are actually very well established. Remember, the board is in a state of transition with its interim chair, and there's quite a few risks associated with this. They sell fast food, unhealthy food that needs to be well prepared, unhealthy food. Why not stop your video here and have a think about these risks? It's a bit of a business question. I hope you enjoyed having a think about it. So let's have a look at these 12 risks. Personally, I really find this interesting because it's a really good indication of what the directors are worried about or concerned about, and gives you a really good sense of what could be discussed within a board meeting. They're really concerned about their key executives and their board composition. They're also really, really concerned about a new entrant to the UK market in the food business. Now, we all love pizza. Personally, I don't, but many students do. They are paranoid that somebody else will come up with something that people like better than pizza. They're very aware of the debate around healthy food in the UK. And they're paranoid that people will move away from pizzas as they seem to be unhealthy into other products. They're under pressure to keep on expanding, even though they've got a very good footplate of stores across the country. Interestingly, given they're a franchise business, and you'd imagine that the head office would have a lot of power to negotiate with franchisees, what they're saying here is they've got some really big successful franchisees who actually are very good at negotiating back against Domino's head office. Fascinating to think about there. All businesses to do with food are obsessed with food safety. Why? Because if there was a food safety problem, think about what people would think about of the brand of Domino's. Obsessive about food safety because it will destroy the brand if there are any problems. They want to make sure that they get raw materials on time to their supply chain centres, and they want to make sure their supply chain centres can keep supplying their businesses or their franchisees. Very, very practical, and we probably don't understand how difficult it is to keep that supply chain running. Again, supply chains don't sound very interesting, but the moment you start thinking about them, they're fascinating. Failure of the online ordering system. And finally, there's a data cybersecurity type risk here. So hopefully that's given you a bit of a sense for all the risks, all the key risks within Domino's. And hopefully you found it helpful me giving you a little chat about the importance of external audit, managed by the Audit Committee, internal audit, overseen by the Audit Committee, and also this notion of risk. Well done for listening to the whole of this video. We'll keep going on this. We've got one more section in the code to do. Have a cup of coffee, maybe have a slice of pizza to celebrate finishing this video. Make sure you have a nice topping on it though. Try and have a healthy topping.